Ladies and gentlemen, the most ultimate and easiest way of trading is with price action. In spite of being so simple, many traders consider it to be the holy grail of trading for how effective it is. So, let's get into it. Price action is trading on the basis of the price movement. And how that's done is, if you notice, the price tends to bounce off within certain patterns. And this is a channel pattern, like a tube. Here you can see the price quite neatly bounces between these two lines that I've drawn. The top line is called the resistance and the bottom line is called the support. So every time the price hits the support, it's a buying opportunity, for it has high probability of going towards the top, the resistance, and every time it hits the top line, it's a good selling opportunity. Now, the reason this works is cause massive buyers and sellers have gathered among these two zones. Every time it hits the support, massive amount of buying takes place, which drives up the price, and once it hits the resistance, likewise massive amount of selling takes place. Now, the reason for a lot of selling is cause of a concept called short selling, which in simple terms means betting against a stock. So how many ever points it falls, the short seller earns that much per share. Hence, it's basically a fight between the buyers and the sellers. Buyers are trying to push the price up and sellers are trying to push the price down. And when one of the side finally manages to take over, it results in a breakout. Now, when there is a breakout, something really interesting happens. The line you see here, that was the resistance line, gets transformed into a support line. And as you can see here, the candles are taking support very well on the same line. Here's another example. You can see the line that was once the resistance, after the breakout becomes the support line. Now that you know the basics of how price action works, let's get precise on what exactly you should do to win your trades. So here are 5 points that's gonna tell you precisely what to do. Number 1. Always swim with a trend. If the trend, which means the overall direction, is upwards, hence always only look out for buying opportunities and not selling opportunities. Now here in this situation, this is an upward trend. Here you should only look for buying opportunities. Now in case you decide to short sell, you might think, oh, I can just short sell here and buy here and make a profit. But here's why it doesn't work. Let's say you see the candles hit the resistance line, it reverses and you decide to short sell. So you short sell it here. I'll put a horizontal line. The line is where you have short the trade, and you can see by the time you can buy it back here, you barely get anything, and that is why you should always follow the trend. This is an upward trend, so you only look for buying opportunities. You can buy here, you can buy here, you can buy here, and boom, it reaches your target in no time. Now, the second point. Use reversal patterns as confirmation. Before taking a trade decision, always ensure that there are at least 2 or 3 indications for taking the trade. Hence, we should not buy and sell just cause it's in a channel. We need more confirmations. Therefore, we can observe the candlesticks for a reversal pattern. So generally before taking a turn, the candlesticks form a reversal pattern like this. And many times they are quite accurate. Now there are many reversal candlestick patterns, hence there's a separate video on reversal candlestick patterns that I'll link to this video and to the description. Next, third point, using risk management. So price action is mostly a game of probabilities. As you can see, it has bounced 7 times on the support so far, and if it breaks down just once, hence you have a probability of winning 7 times and losing just once. But since you will know of the channel's existence only after the first 3 points, hence your actual probability is winning 4 times and losing just once. And that's not it. Every time I win, I take roughly 20%, and for when I lose, I cut my losses and end my trade as soon as it goes below 3%. Risk to reward ratio should be used in all your trades. If I lose, my risk is 3%, and if I win, my reward is 20%. Hence, the risk to reward ratio is 3 is to 20 or 1 is to 6.6. Using a good risk to reward ratio is key. So, even if everything goes wrong and you lose a dozen trades, but win just 2 trades, you would still be profitable. Now, the fourth point, drawing patterns correctly. There are two ways in which people draw the trend lines. One way is it's plotted on the candles, which means you basically connect the end of the candles and draw the line. Then another way is it's plotted on the wicks. You draw the line by connecting the wicks. Earlier I used to plot it on the candles, but I find connecting the wicks to be more efficient. Now in this scenario, in case I have connected to the candles instead of the wicks, it would have hit my 2% stop loss and I would be out of such a beautiful trade. Now moving to how to draw these lines. You don't have to try and connect every possible wick. Instead, you need to draw and connect just one pattern that's the most obvious, as the pattern only works if other buyers and sellers also sees that pattern. Go with the most obvious and visible pattern you can find, and this can work in any time frame, 15 minutes, 1 hour daily or even monthly, and it will still work perfectly. Now the fifth point, learning the important patterns. The pattern that I've spoken of throughout the video is the channel pattern, but there are other patterns too. You don't have to know all the patterns that exist, but knowing just 4 or 5 of the most important patterns can be of great use. Now the price action patterns are of two kinds. We have the reversal patterns, just like the channel pattern where you buy on the basis of reversals, and then we have the breakout patterns. These are patterns that gives opportunities to massive breakout where the price just explodes in one direction. That's a breakout pattern. One of the best breakout pattern is a triangle pattern. A triangle pattern works similarly to a channel pattern, except it's in a triangle shape, and once it comes to the end, it breaks out in either one of the directions. There are two ways to trade a triangle. One is on the reversals and other on the breakout. A good way to measure approximately how big the breakout can be is by measuring the base of the triangle. Here the triangle has a base of roughly 60%, and the breakout it gives should also be roughly 60%. Another really good pattern for breakout trades is the flag pattern. It's known to give massive amount of returns in short period. It basically looks like a flag. It has a pole and an area of consolidation. This is only a breakout pattern, and the way to trade is to enter as soon as it breaks out of the consolidation. A flag pattern breakout is measured by the length of its pole. So if the pole is roughly 50%, the breakout expected is as well roughly 50%. And it generally gives the entire breakout in a short period. When it comes to a channel pattern, there isn't a way to know how big the breakout would be. Channels are better suited for reversal trades. But if you want to trade a channel breakout, I would suggest to keep a reasonable fixed target and exit at that price. The channel pattern, the triangle pattern and the flag pattern is just 3 of the popular price action patterns. There are many more patterns, but these 3 are my favorites as they are known to be reliable. I have many more price action videos that speaks more in detail about these patterns. I'll attach them to this video's playlist. You can check them out. If you want to learn simple yet wonderful strategies on how to take your trades, I have plenty of simple and easy to understand videos that you can check out.